Good morning, this is Brett Bjornson, and this is the Estate Planning Daily Show. Today I want to chat a little bit about the valuation issues that I've been talking about. By valuation I mean, what is the fair market value of an asset at date of death? Why that's so important, as I've mentioned, is that you receive a step up in basis in the assets, which means that when you sell them you really have no gain or loss. You might have a loss if you have a real estate commission involved, and you'd have a loss for that cost because you increased your basis to the fair market value. And if you pay a commission on a building, that can result in a loss overall for tax purposes. But independent of that, when two people own a piece of real estate, for instance, they both have a 50% interest in $1 million building, and one of them decides to sell, that 50% isn't necessarily worth $500,000. And the reason it's not worth $500,000 is because nobody really wants to have a partner. Nobody really wants to have to worry about dealing with a partner and having to negotiate when the property is sold. And because of that, the property receives a discount for that 50% interest. It takes a shave in value. A willing buyer is going to come along and purchase that 50% interest for, say, $400,000, not $500,000. That's what we call a valuation discount. It's required to be backed up with an appraisal, and that appraisal should come after an appraisal of the underlying real estate, and that would be considered a discount appraisal. I want to talk about this more tomorrow or next week, but wanted to get off with some topic on the valuation discount issue, and I'll look forward to seeing you next week. Have a great weekend.